Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you today. And as always, make sure you visit our website, ReznyWealth.com, and send us your questions for today's show to Brian Rezny at ReznyWealth.com. You know, it's an interesting year, 2022. We've got obviously hyperinflation at 40-year highs, although it seems to be abating a little bit, and I've talked about that earlier in this year, and I'll talk about that more. Obviously, interest rates are up substantially, and there's a lot of talk about recession, or is it already here? Bottom line, inflation is high, and a lot of the indicators that the government looks at, again, are lagging indicators. If we look at a lot of the leading indicators, things are already starting to roll over on inflation. So what's interesting is, while inflation is high, as we get into 2023, we firmly feel inflation will come down a lot. There's also a potential for deflation depending what the Fed does with interest rates, if they're too slow to stop raising rates and potentially not reduce rates, which we feel they're going to have to do in 2023. Of course, inflation's a problem, but it's abating. Interest rates are up. Eventually, they'll come down. It's a cycle. So when we have a lot of talk now about recessions and all these kind of big banks and Wall Street firms, which are, by the way, are always late to the party, are all talking about maybe a potential recession now. Folks, bottom line is this. The economy has already slowed. There are cracks in the foundation. There's pockets of recession already. So I will say, yes, we're already in a very mild recession. This is not the recession that we saw, back in 2008 from the boom and bust of housing that was really overblown, and the banks were in substantial leveraged positions and in bad trouble. We're not in that situation. So again, while the market's been volatile, we see this as an incredible opportunity to get rid of bad positions you should have not owned in the first place and really upgrade that portfolio. That's what we've been doing throughout the year, and unfortunately a lot of investors freeze and they don't do what they should be doing when it's the right time to start upgrading your portfolio. A little bit about market timing. Make these changes now is one of the things that I'm going to suggest. I talked about oil at the beginning of the year. We still like oil. I talked about avoiding emerging markets and avoiding Europe specifically. We still believe you should avoid Europe and the emerging markets. I firmly believe as we finish out this year and as we go into 2023, I think one of the best places to be invested is going to be continued to be the U.S. marketplace. Why? Because we're the strongest economy in really a overall bad world economy. So who will probably come back quicker, in our opinion, is the U.S. marketplace. It's interesting. With all the new clients that my firm gets every single year, we're still seeing the majority of you that are with the big banks and brokerage houses still have a whole bunch of money in international investments. And I keep asking people, why do you still own international investments? They've done poorly for 10, 15, 20 years. And the opportunities going forward, in our opinion, are slim pickings, meaning you're taking the risk of international without really that opportunity. So again, make sure you understand that at the end of the day, own assets that have opportunity to go up. Why own assets that have less of an opportunity but have as much or if not more risk than the U.S. marketplace? Now, there may be a point in time where the international marketplace has opportunities, and we are always looking at that. But I will tell you right now, we continue to be U.S.-centric in our portfolios, whether it's bond-related or equity-related. A little bit about the bond market. Let's talk about what's really going on there. The most interesting thing with the bond market is this. If you look at the long-term government treasuries, by the way, supposed to be the safest investment in the world, you're looking at long-term government treasuries down over 30% year to date. 30%. The equity market isn't even close to down 30% year to date. But wait, you say, I thought the equity market's risky. You know what? All investments have degrees of risk depending on the cycle. I've talked about that a lot over the years doing my TV and radio shows. But unfortunately, investors are slow to act and make adjustments to portfolios. So where are we today? First off, in our portfolios, between holding some cash and very short-term or floating rate type bonds, which are the better, in our opinion, bonds to hold this year, which has been proven correct, we are now looking at the potential to actually go out on the yield curve, meaning the maturity level of the bonds. Because interest rates are already up, bond values go down. So what we want to do now is we're starting to look at repositioning some of our bond assets as we get into next year, as we see more cracks in the foundation where the Fed will probably slow raising rates and potentially start reducing rates. That's when you want to own longer dated bonds. And again, I talked about that at the beginning of the year. For those of you who follow my show, hopefully you heeded that warning and you reduced the maturity level of your bonds so you weren't down 30 or 20% on your bond portfolio. Maybe you're only down 3 or 4%, which is a lot better to swallow than 30. Again, bonds have risk. Unfortunately, most investors have a buy and hold asset allocation through Wall Street or their brokerage house, and that just doesn't work in a rising interest rate environment, and it's going to come back to haunt you again because you're going to miss out on the opportunity maybe going longer maturity when rates eventually come down. Remember, all the investment markets go in cycles. They go up, they go down, whether it's interest rates, the stock market, real estate, oil, gold. All assets go through cycles. You need to understand those cycles, read those cycles, and adjust your portfolio. Buy and hold, set it and forget it is no way to manage your money. And if you're finding that your current firm is pretty much on the sidelines and not doing any real productive management of your assets, it's probably time that you called a real money management firm. Call Rezny Wealth Management. We do manage larger portfolios. Call us for a consultation to discuss our services so we can get you back on track. Again, these are the things that are important to investors: is financial security and, of course, that peace of mind. But if you're setting and forgetting it, or your so-called advisor is not communicating with you, where's your portfolio really headed? It could be going in the exact wrong direction. One of the things that keeps coming up, even with this volatility, is, of course, annuities. I've talked about annuities repeatedly over the years. Why annuities are junk and why your so-called advisor sells them. Let me discuss something that is really disturbing. If I look at this year alone, we have talked to probably 15 to 20 new clients that every one of them was sold some kind of crummy annuity or multiple crummy annuities. What's interesting is when I asked those individuals, why did you buy the annuity? They thought they were getting something for free. They thought they were going to get a free money bonus. They thought they were going to take no risk. They thought they were going to make stock market type returns. And all of those things were not true at all. And what a lot of these people realized is they got caught up in basically a sales pitch by a so-called advisor. Annuities are sold, and the only reason advisors or firms sell annuities is one reason. It's called commission. And those commissions line their pocket better than yours. Folks, there's no free lunch. If you're a highly emotional investor and you think you're going to get something for free, you're going to get taken to the woodshed by the annuity salesperson. That's the bottom line. If you want something risk-free, go to the bank, buy yourself a laddered CD approach or CD investments, and call it a day. You're not going to make much money. You're not going to make much, if anything, with those annuities either. The difference with a CD, it's guaranteed by the FDIC. You've got liquidity, and that is really key. Liquidity in case things need to change, where annuities have basically almost no liquidity without huge surrender penalties to get all of your money, often approaching 10 to 12% penalty ratios that can go as high as 10 to 15 years long. That's ridiculous. Annuities are garbage. They're junk. Don't buy them, and don't let your so-called advisor try and sell you another one. And if you're one of those suckers that goes to the free steak dinner and believes you're going to get a free money bonus, again, think again. There's no free money with annuities. It's only coming out of your pocket, going into that so-called advisor's pocket for commission. Folks, I'm going to take a quick break. Send your questions to Brian Rezny at ReznyWealth.com, and make sure you do visit our website, ReznyWealth.com. I know a lot of you out there call our office during the week. Call our office if you'd like a consultation to discuss our services. If you're realizing your current advisor is not up to the job, They haven't done a good job. Your communication is lacking, and you want a real firm to manage your money properly. Rezny Wealth Management is there for you. We do manage larger portfolios. Call us, visit ReznyWealth.com. I'll be back right after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Hopefully you're enjoying today's program. As always, send your questions to Brian Rezny at ReznyWealth.com. You know, just before the break, we were talking about annuities, and it's amazing the amount of questions that I get about annuities. Is this annuity better than that annuity? Folks, all annuities are garbage. They have high expense ratios that take away from your return and, of course, limit your ability to get all of your money out if you decide you want to change your mind without penalty. So there are no good annuities. There's just people that think they're going to get something for nothing, and that's simply not the case. Joshua in Naples. Semiconductor companies, especially U.S.-based semiconductor companies, what would happen if China were to actually invade Taiwan? Would that make semis skyrocket? I'm holding a 3-year leveraged ETF. Not smart, but what is done is done. Joshua, I think what you're asking me, will semis go up, semiconductor stocks go up if China invades Taiwan? And your second part of your, or at least comment was, it sounds like you have a 3-time leverage ETF that you're invested in. Big mistake. So let me explain. First off, if China, which could happen, who knows today, 5 years from now or sometime in the middle, could they invade Taiwan? Is that going to have a huge impact on the semiconductor world? Probably on the short term, maybe. But realistically, semiconductors in general, whether China goes into Taiwan or not, we like semiconductors. They've been beaten up substantially. We think there's good valuation there, and there's good long-term potential growth in semiconductors. Fair disclosure, we do own positions in semiconductors throughout the world. Your other comment, though, about being leveraged. One of the things I want to stress, Joshua, is leverage will get you into trouble. So you can use some leverage in a light fashion, but understand your risk profile. And if you are going to use leverage, don't do leverage when things are real frothy and everything is incredibly great. Maybe you want to add a little bit to a leveraged ETF, 5 or 10%, but maybe things are down substantially, like what we've seen in this year to date, 2022. So at the end of the day, leverage creates a lot of risk. Realize that. But maybe adding a little bit of ETF that's leveraged when things are really down might be a great opportunity to recoup a little quicker, again, when you're buying things that are down 20, 30, 40%. But great question in general. Mike in Florida. First, I would like to thank you for your very informative radio session and what you share with us. I'm looking to purchase a home. In purchasing a home, does it make sense to take money out of my 403B plan or not? Mike, great question. Generally speaking, what I'm going to say is this. If you're going to buy a home, do not take money out of a retirement account. That retirement account is for retirement, okay? If you have no other source of down payment and you have to, no matter what, take it out of a retirement account, then do it. The problem is, again, if you're under 59.5, there could be a penalty. You can borrow the money out depending on your plan at work. If they allow you to do a loan provision for part of the money, and then it gets paid back to yourself. But one of the things I suggest is retirement money should be set aside for retirement. Don't tap your retirement for other things like a down payment, buying a car, or a vacation. Those things just don't make a lot of sense at all. John in Florida. Brian, what are your thoughts on buffered ETFs? Folks, an ETF is an exchange-traded fund. Buffered means, and these are our newer ETFs in the last 2, 3, 4 years that have come around, and I will say this, Every time there's a new fad investment, and I think buffered ETFs are a fad, we saw buffered mutual funds back in the 80s and 90s that all kind of went away and didn't work out that well. What a buffered ETF, all it means is it kind of puts a collar around how much you can go down and then how much you can go up. The problem that I find with buffered ETFs is the expenses are high, and again, if it buffers you going to the downside only for a certain limit, the problem is when things come back, you're buffered going up then in addition. So you could go down, things could go down worse, but then on the recoup, you're buffered going back up, so you never recoup what you actually lost. So it's gimmicky. I think there's better ways to manage risk in a portfolio. But remember, if you have a portfolio that's a growth portfolio and you drop 12% instead of 10%, that's not a big difference. But ultimately, it's what you make when things recoup. So now if that portfolio that dropped 12 recoups 20, and the portfolio that dropped 10 only recoups 8, you can kind of do the math. You're further behind. So I don't like buffered ETFs. I don't recommend them. And I think investors in general have to realize sometimes it makes sense to take the risk in order to get the reward. Trying to do hocus pocus or kind of offshoot investments that maybe kind of sound good in a sales pitch often take away a lot of the return over a rolling 3 to 5 year time frame. So again, real investing with low-cost investments. I like ETFs, exchange-traded funds, but not all of them I like, but I like the concept of them. And we actually use a number of ETFs in our managed accounts for our clients. I'm going to take a quick break. When I come back, we're going to take more questions, but make sure you do visit ReznyWealth.com and make sure you click on that consultation tab. And as always, if you have questions about your portfolio, if you're concerned about maybe an investment or your retirement, send me a question for today's show to Brian Rezny at ReznyWealth.com. That's Brian Rezny at ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. I hope you're enjoying today's program. Again, send your questions to Brian Rezny at ReznyWealth.com. You know, we're getting a lot of great questions in, and one of the general comments that I want to make, your question is probably a very similar question than another 1,000 people that watch my show have. So again, send those questions in. Get an answer. One of the things that I always hate seeing is somebody who had a question, never sends it, and goes and sold some investment through their brokerage house or bank that they should have never bought, but they could have asked me about it before they did it. Ask me after the fact, after you've decided to do it. Of course, that could be very costly. And I see a lot of these things come up. One of the interesting things that I've seen, especially as we've gone through, obviously, a fairly rocky, volatile 2022, is investors, again, who have oversaturated their portfolio in the bond market. Remember, bonds have risk, just like all investments have risk. And again, as I talked earlier in this half hour, the bond market, if you look at long-term government treasuries, again, are down more than the equity market if you look at the S&P versus, let's say, long-term treasuries, the TLT. So ask yourself this. If bonds are supposed to be safe, but they've been more volatile and down more than the equity market, why do I own bonds? Again, that's another discussion for risk management in a portfolio. And sometimes you need to change up that bond portfolio with different types of bonds, different maturity bonds in order to meet your objective. Mark in Naples, thought on ARC Innovation ETF and Fidelity Metaverse ETF as part of a Roth IRA? Mark, great question. First off, what I'm going to say to you is this. I'm not a fan of the ARC ETFs in general, and I'll go back to this. If you look back at the year 2000, a lot of the ARC ETFs had these incredible returns because a lot of the stocks they were buying were these hyper growth stocks that had no earnings. Kind of remind me back of the tech boom and bust of 2000 when a lot of these innovative companies which had no money or made any money and weren't projected to make money for 10 or 15 years went up 3, 4, 500% in a year and then crashed down and went out of business. So I do not like the methodology around ARC. I would not buy those. The Fidelity Metaverse, kind of the same scenario. I'm not a fan of that ETF either. What I would say to you is this, a diversified ETF or specific sector ETF, like maybe the oil market or areas like that, to me are better opportunities. In your Roth, stay diversified. Don't do ETFs that have been gimmicky and are one trick ponies, meaning they had one huge year. And now if you look back what they did before the big year, it wasn't that great. You take the big year, you add in now these couple years where it's down 70, 80%. Your returns are mediocre at best. Anything that goes up 100-some% in one year should not be bought the following year. Past performance is not indicative of future results, yet I find people always like to buy what did best the year before for the current year. That's been proven to be a huge mistake, a huge reduction of return, and a huge increase in risk. Jeff in Fort Myers, I chased the AARK and got destroyed. Hold or sell? I bought at 112, went to 160, now at 50. Jeff, you're kind of similar question to my question before. Again, this is the ARC family of funds. I will tell you that I've had just 40, 50, maybe 100 questions on the same topic on my TV and radio shows in the last year and a half. I would not own the ARC family. I don't like them. I don't like the stocks they own. I don't like the methodology. You do your own homework. But at the end of the day, if I owned it, you obviously have a negative cost basis. Sell it for a tax loss. In my opinion, move on to greener pastures. Don't buy into hype and high overvaluation stocks or ETFs that buy those kind of stocks because they may look good for a little bit. But when they turn south big, and you lose a lot more than you ever made. Phil in Fort Myers, Florida. You mentioned a lot about staying away from annuities. Does that hold true for variable annuity? Also, any feedback on Thrivent Financial? Phil, whether it's a variable annuity, an equity index annuity, annuities in general, I do not like. I think they are garbage. And the reasons are simple. You have incredibly high surrender penalties to get all your money out for multiple years. You have higher taxes when you take money out because it's taxed at ordinary income. Why would you pay extra taxes? Makes no sense. The expense ratio on annuities and variable annuities, again, are right in this ballpark, have incredibly high expenses. The average variable annuity that my office reviews has an expense ratio, annual expense ratio every year of between 3.5% and 4.5% a year. Think about that. 3.5% to 4.5% every single year. That's ridiculous. Unfortunately, most people never look at the fine print in that annuity prospectus. The person that sells annuities is selling these really under suitability, and that means they don't legally work for you. They care about the big commission. So if you have, let's just say you have a variable annuity, whether it's through Thrivent or anybody else, but let's just say you have a variable annuity. Your expense rate is 4.5%. If that annuity makes 9% and your expense ratio is 4.5% against that 9%, how much do you get to keep? Only half of the return because the other half's going to expenses. That's crazy. So you're taking the same risk of the investments, but you're making half the return. Thrivent sells annuities. They manufacture annuity-based products. I would tell you if you're invested in any company, whether it's Thrivent or any other brokerage type firm or insurance company, make sure you check them out on the SEC site. Have they ever been fined or censured? Go to the FINRA site, same thing. Unfortunately, investors do not take the time to research properly the firm they entrust their money. And when they finally do, guess what happens? They kind of are shell-shocked on the fines and the magnitude of those fines against the client and you. So I don't like annuities. I don't like variable annuities. There's no reason to buy them. You can build a diverse, inexpensive portfolio, have it properly managed by a real fee-only fiduciary money manager like Rezny Wealth Management, and save all the cost and headaches of surrender penalties and the cost structure that goes to the insurance company, and put that money back into your own pocket. Ted in Cape Coral, Florida. Are IPOs good? IPOs is an initial public offering. They're not good or bad. It depends on the company that's IPOing. What I would say in general, Ted, avoid IPOs. Let me explain why. When a company goes IPO, they're looking to raise money. The company that is the investment bank that basically does the deal, let's call it the IPO deal, their job is to get you, the investor, to buy these IPO shares almost at any cost. And often what I find with IPOs, at least the first year to 2 years, is often a bad time to buy most IPOs because there's not enough financial data and track record. If it's going to be, as an example, you think it's going to be the next Microsoft. Well, if you wait a year or two to buy it after IPO, where you can do better research once it's IPO'd, you still have a great opportunity to make money if you think it's the next Microsoft. But I suggest staying away from IPOs from the get-go. Wait a year or two, do your research, and at that point you can put your toe in the water and potentially buy one. And in South Carolina, what would you do with cash after selling stock? Great question. So what I would say is this: if you sell a stock and you've got a bunch of cash, you should already have an idea where you want to put that money. Think about this. When you go to sell a stock, you're selling a stock because either A, the thesis has changed, the reason you own it, meaning it's not going to grow anymore, it's going through changes in their business model, or there's better opportunity for that money. So if you sell a stock and it goes to cash, you can either leave it in cash, but you should already have been researching along the way other opportunities to deploy that money. So cash is cash. You're not going to make much. Your ultimate goal is always to be doing research, always trying to upgrade a stock or a position in your portfolio for the future. Jerry in Cape Coral, Florida. What about investing in gold or precious metals? Not a fan at all, Jerry. So what I would say to you is this: there's times that gold or silver may be appropriate for the portfolio. I firmly believe now is not the time. I think there's better opportunities. People, for some reason, think gold and silver are inflation hedges. They're really not great inflation hedges at all. So we don't own any gold or silver currently, and I recommend you don't either. There's greener pastures. Folks, I'm just about out of time. As always, if you have questions about your portfolio, send those to Brian Rezny at ReznyWealth.com. Make sure you visit our website, ReznyWealth.com. If you're tired of bad advice, poor client communication, and feel like your advisor's just not up to the job, call Rezny Wealth Management for real advice. We want to help you. We want to get you back on track. We're a fee-only fiduciary money manager, providing exactly what you need. Real money management, real advice, real client communication. Call our office during the week. Visit our website at ReznyWealth.com. We'll see you next week.